NASDAQ 100. Will Genius Bill mark the end of the box range? 23K breakout in sight? Hello, this is JinLog, your top trader and market analyst. This video includes both technical analysis and scenario-based strategy discussions. Blog format summary is also available for quick reference. Following the post regarding the one-month consolidation after the Genius Act announcement. After the Genius Bill announcement, NDX entered a one-month box range. With rhythm expansion now underway, key technical zones are being revisited. War-related headlines appear more like macro control narratives than actual market disruptors, suggesting a calculated transition into a full swing and mid-term expansion phase. Short-term trend. Maintained right-pointing arrow rhythm expansion right-pointing arrow entry. 22,000 swing trend. Maintained right-pointing arrow rhythm expansion right-pointing arrow entry. 21,650 mid-term trend. Maintained right-pointing arrow rhythm expansion right-pointing arrow entry. 21,500 current price. 22,534. 5. Investment outlook short-term. Rhythm breakout likely right-pointing arrow 23,000 in sight swing. Solid uptrend right-pointing arrow target 24,900 mid-term. Long-range continuation to 26,270 expected 6. Chart commentary. This is the chart for the NASDAQ 100. Highlighted zones mark key merge points in short-term trends with bullish structure. The closer we are to swing or mid-term trend lines, the higher the probability and yield. Always monitor rhythm and wave formations on each chart. 7. Rhythm analysis short-term rhythm. Expanding right-pointing arrow confirmed if 22,000 holds swing rhythm. Entry at 21,650 shows upside potential in expanded structure, mid-term rhythm. Expansion phase activated right-pointing arrow momentum buildup from 21,500. 8. Financial overview. Index-based report, individual earnings not detailed. Focused on composite earnings trend for tech I-heavy constituents key weight. NVDA, AMD, MSFT, Goog, AAPL right-pointing arrow guiding rhythm flow. 9. News, risks, events. Genius Bill triggered a box pattern over 4 weeks. Geopolitical conflicts serve as justifications for liquidity control, death and injuries, seen as tokens in macro chessboard by institutional players. AI optimism plus Fed's pause stance on rates equals bullish drivers. 10. Strategy scenarios checkmark short-term strategy entry zone. 22,000 condition. Rhythm expansion plus short-term trendline support plus momentum confirmation checkmark swing strategy entry zone. 21,650 condition. Expanded rhythm plus trend confirmation plus second stage trap cleared checkmark midterm strategy entry zone. 21,500 condition. Long-term rhythm breakout plus earnings tailwind plus structural wave support. 11. Elliott wave analysis current phase. Wave 2 complete right-pointing arrow wave 3 onset likely scenario. Accumulation between 21,500, approximately 22,000 wave targets. Wave 1 peak, 23,000 wave 2 base 21,500 wave 3 target, 26,270. 12. Community sentiment platform keyword sentiment summary, Reddit hashtag NDX, hashtag iStocks neutral right-pointing arrow bullish AI still hot, but overvaluation mentioned, StockTwits hashtag NDX 100, hashtag Genius Bill rising interest, expecting strong move after Genius Bill Twitter hashtag tech rally, hashtag macro control mixed even war seen as a market control tool. Forecast, box breakout likely. Full swing wave beginning risks. Earnings disappointments, macro event fatigue, no fresh narratives flow factors, continued AI fund inflow from institutions technical note, rhythm expansion equals signal for ongoing upward trend 14, advanced insights institutional flow, confirmed via leveraged ETFs, e.g. TQQ, QQQ, social mentions plus 41% increase month over month, short interest, being covered in low volume POPs AI flow, heavily concentrated in mega cap tech right pointing arrow mid-tier AI plateau 15. Disclaimer, this report is based on the VPAR rhythm analysis system. All rhythm flows, wave interpretations, and scenario setups are for educational and strategic reference. Investment decisions must be made at the investor's sole discretion and risk.
Welcome to the deep dive. Today we're really cutting through the noise. We're going past the headlines, getting straight to what's actually shaping, well, one of the most watched parts of the market, the NASDAQ 100, the NDX.
Mm-hmm.
And, it's funny, sometimes even with something this complex, you see these market movements, and they seem to follow this, distinct rhythm, a pattern, almost like a dance, really.
Yeah, like a choreographed dance. It's not just chaos.
Exactly. Not just random ups and downs. There's an underlying beat. And today, we're going to try and uncover that story, the one unfolding behind the daily market ballet.
That's precisely our mission here. Yeah, we're taking a deep dive into these recent market dynamics, zeroing in specifically on the NASDAQ 100. The goal is, well, to peel back those layers, get past the daily stats and noise, and really understand the technicals, the different strategic scenarios, and the forces underneath it all that are shaping this index. We'll be unpacking, an expert market analyst's perspective here. It's one that kind of weaves together these really detailed technical insights with the bigger picture, the macro narratives. We want to show you, our listener, where the market might actually be heading, especially after this significant event the source calls the Genius Bill.
Right, the Genius Bill. We'll get into that.
Yeah, and the whole point is to give you a really comprehensive, but still, easy to digest overview, regardless of how much market stuff you already know. Think of it like a shortcut to being genuinely clued in, maybe with a few surprising bits thrown in.
And the source material we're using today, it's pretty exceptional, actually. It's this really in-depth market analysis report. It blends detailed technical charts, this fascinating rhythm analysis we mentioned, current news, even what people are saying online, community sentiment.
It pulls it all together.
Yeah, it's a really holistic view of the NDS because there's multiple ways to look at it. So let's just jump right in with, well, the big question from this report. Will this recent Genius bill, whatever it might be, will it actually mark the end of the market's current holding pattern, this box range? And maybe even more interesting, what does rhythm expansion really mean for how you understand what might happen next?
Yeah, these are absolutely central concepts to grasping where the market is right now and, well, where it might be going next.
Okay, let's unpack this right away then.
Yeah.
Our journey into the NASDAQ Q100, it really kicks off with this event. The source flags as pivotal. The announcement of something it calls the Genius Bill. Now, we should be clear, the report doesn't actually detail what this bill is.
No, it doesn't.
It's used more like a placeholder, right? A powerful label for some big legislative thing or policy change that really acted as a catalyst. What we do know is how the market reacted immediately.
That's right. Right after this, let's call it impactful Genius Bill announcement, the NASDAQ Q100 went into what the analysis calls a 1-month box range consolidation. Now, for anyone maybe not super familiar with market terms, or even if you follow it but don't dive deep into the technicals, imagine a box range like this.
Yeah.
The price just bounces
Right.
between a set floor and a set ceiling. Like a ball trapped in a room, It's not really going up or down decisively, just sort of oscillating in this tight band.
So not a strong direction, but more like a pause, like the market's holding its breath trying to figure things out.
Precisely. That sideways movement, that consolidation, it's often a classic sign. The market is absorbing new information, gathering energy. It's trying to price in what this big announcement, the Genius Bill, actually means long term.
Because it's not always obvious right away.
Exactly. Sometimes these huge policy shifts, they don't cause an immediate surge or drop because the effects are complex, maybe unclear at first. So instead, you get this initial uncertainty. People hesitate. And that leads to this contained horizontal trading. The market just needs time to digest it all. And this box range, well, that is the digestion period, building up potential energy for whatever comes next.
Like compressing a spring.
Exactly like compressing a spring, yeah. Storing up that energy before it suddenly lets go.
That makes a lot of sense. It's like the market was just, stretching, warming up, and now maybe the real race is starting. And what's fascinating is what happened after that box range. The source says, okay, after this consolidation, rhythm expansion has begun. That sounds like breaking free, stretching out. What does that mean for us?
It absolutely signifies a breakout. Yeah. Rhythm expansion is a key technical signal, according to this analysis, and it's defined very clearly. It's a signal for an ongoing upward trend. So after that month of bouncing around inside the box, the market's breaking out, is starting to move with more defined, more sustained upward momentum. This isn't just a little blip. It's presented as a real shift in the market's underlying tempo, its direction. It suggests a more energetic, directional move is taking hold.
So what does this imply for, say, the stability or predictability of the market now? If it's not in that box anymore, does that make it more predictable or maybe less? What should you be thinking?
Well, it signals a potential shift away from that volatility and indecision you see in sideways markets towards a more defined, trend-driven environment. So for you, the listener, it means the market might actually become more directional and potentially more predictable within that developing upward trend.
Okay, within the trend.
Right. It's moving past the uncertainty, starting to signal maybe a clearer path, at least for the near term.
Wow.
This shift from the box range, that period of indecision, to rhythm expansion, it's seen as a pretty powerful indicator that the market dynamics are changing, moving from holding its breath to striding forward with more confidence, finding its footing.
That's a really clear distinction. Okay, so the market seems to have picked a direction for now. Speaking of paths, let's get into the specifics, the technical landscape. The report gives us the current price snapshot in NASDAQ Q100 at 22,534. But crucially, it also identifies several critical entry points or support levels. This isn't just about today's price, is it? It's about where we are relative to like historical markers.
Exactly. It's all about context and identifying these really pivotal thresholds. The current price, 22,534. That's just one number. What's really useful here are these specific entry points and support levels the analysis highlights for different time frames, different trend horizons. It points to a short-term trend being maintained if the entry point of 22,000 holds, so the immediate upward push has a floor there.
Right.
Then a swing trend is maintained if 21,650 holds. That looks at the health of a slightly longer move, maybe over a few weeks. And finally, a midterm trend maintained if 21,500 holds. This is the deepest, most significant support level mentioned here, reinforcing the overall longer-term bullish structure, often looking out over months.
So simple logic then. If the price stays above these levels, good sign, trend is strong. If it drops below, maybe signals weakness. What happens then?
Precisely. Think of these entry points like foundation layers for a building. If the price stays above these specific levels, it just reinforces that upward trend for that time frame, short, swing, or mid. It suggests buyers are active there, preventing drops. But conversely, yeah, if the price were to fall below one of these levels, it could signal a significant weakening of that particular trend, potentially a shift in momentum, maybe even a reversal. It would definitely require a rethink of the market's direction. These aren't just random numbers. They're key benchmarks watched closely by traders, by algorithms.
And what's really interesting are these key technical zones the source points out.
Yeah.
It says these zones mark key merge points in short-term trends with bullish structure. And then adds this. The closer we are to swing or midterm trend lines, the higher the probability in yield. Okay, that sounds important. These are just lines in a chart, right? What makes these zones so powerful?
No, you're right to pick up on that. They're not arbitrary at all. What's fascinating, supposedly, is that these are areas where different market forces, different technical indicators, they all kind of converge. They line up, which is why they often act as really strong support or resistance. Because lots of market participants, from individuals right up to huge institutional algorithms, they're all watching these levels and reacting to them. It creates a sort of consensus point, a collective agreement on value.
And the merge points with bullish structure part.
That suggests that various positive signals, things like moving averages, maybe Fibonacci levels, previous highs, they're all pointing to the same area, reinforcing each other, creating this like strong magnetic zone for buying interests.
Okay, so that line. The closer we are to swing or midterm trend lines, the higher the probability in yield. What does that really mean for someone watching this, maybe making decisions? Is it about timing or market psychology?
It basically implies increased confidence in the trend continuing,
Well,
and therefore maybe a better risk-reward setup for those involved. Being near those stronger, more established trend lines suggests the existing upward momentum is more likely to keep going with conviction,
right.
which could mean potentially greater returns the yield part for investors who are aligned with that trend.
Yeah.
And it also gives clearer risk management points. Like if the price breaks below that strong line, the conviction is gone.
Right.
Right? So for you, the listener, understanding these specific levels helps you gauge the market's strength and direction more effectively. It's more than just the current price. It's about its relationship to these established technical boundaries and what that tells you about the market's underlying health. It's like knowing where the strong pillars are on a bridge before you drive across it.
It's a fantastic analogy. Really helps visualize it, understanding the structure, the foundations. And this leads us perfectly into one of the most intriguing ideas in this report, rhythm analysis. The word rhythm pops up constantly, and rhythm expansion is key, as we said. How should we really understand this? Is it just a cool metaphor, or is there something more concrete behind it?
Well, connecting it to the bigger picture, rhythm here is definitely more than just a metaphor. It refers to the underlying momentum, the patterns of price movements that this analysis suggests are somewhat predictable, based on specific technical indicators.
Okay.
It's about how the market kind of breathes, expanding, contracting, moving in these discernible cycles. Think of it less like random noise, more like a complex piece of music, different instruments playing together.
The music analogy again, I like that.
Yeah. Each rhythm, short-term, swing, midterm, has its own tempo, contributing to the whole melody. It's about trying to hear that underlying beat driving the price, not just reacting to every little note. This analysis identifies these recurring patterns that suggest where momentum is building or fading.
Okay, so if the market's a symphony, what are the specific instruments or rhythms the report is highlighting right now? What are they telling us about the current performance?
Right, let's break them down, and we can go from the immediate pulse to the broader beat.
Okay.
First, short-term rhythm. The report says this is currently expanding, and it's confirmed if 22,000 holds. So the immediate up move, the daily stuff, is showing sustained energy. Think of it as the quick, lively melody in the symphony brisk, ongoing upward momentum right now. The market's quick step.
Okay, lively melody. Got it. What's next?
Next is the swing rhythm. The entry point here is 21,650, and the analysis says this shows upside potential in expanded structure. This points to strong growth potential over a slightly longer time frame, maybe a few weeks, couple of months. This is like a sustained chorus in the market song, building on the short-term stuff, but indicating a more robust medium-term trend is in place and could go further.
The chorus, right. And the big one, the midterm.
Exactly. The midterm rhythm. This is described as having its expansion phase activated with momentum buildup from 21,000. This is like the foundational beat, the bass line of the symphony. It suggests a strong, sustained upward trend is really taking hold over a longer horizon, months, maybe even a year, with significant underlying momentum. This rhythm indicates deep structural support for more growth.
Wow. So if you're really trying to listen to the market song, these different rhythms give you this layered understanding. From the immediate shifts to the longer sustained trends, it's like having different camera lenses, right? Close up, medium shot, wide angle. What does that mean for you, the listener, practically?
Exactly. It's about understanding the whole symphony, not just reacting to single notes. Short term gives you the daily pulse. Swing rhythm gives you the weeks to month view, showing developing trends. And the midterm rhythm reveals the big picture, the grand narrative for longer term thinking. So for you, the listener, understanding these different rhythms means you're not just reacting to headlines or daily price swings. You're hopefully comprehending the underlying multi-layered momentum. It offers a much richer, more nuanced view of where things might be headed, which ideally helps with more informed decisions.
That's a powerful way to look at it. Okay, so technicals and rhythms give us the how, but we also need the what and the why. What's fundamentally driving this market? The report moves beyond just individual company earnings, focusing instead on composite earnings trends for tech-heavy constituents. Why is that distinction important for an index like the NASDAQ 100?
Well, it's crucial because for an index like the NBX, which is so heavily weighted towards tech, the overall collective health of its biggest players matters way more than, say, one smaller company hitting it out of the park or another one stumbling.
Right, it's the average almost.
It's more than the average. It's the weighted average. It's the collective financial heartbeat of the big tech sector. The source actually names the key weights guiding rhythm flow. NVDA, AMD, MSFT, Google, and AAPL. These are the titans, right? The bellwether.
So the performance of just these few giants can really skew the whole index. It's not about some hot new startup. It's about whether these behemoths are doing well.
Pretty much, yeah. Their financial performance, their growth outlook, their innovation that can single-handedly set the tone for the entire NASDAQ 100. If these giants are thriving, their sheer size and influence can lift the whole index, even if smaller companies are having a tougher time. Their collective earnings, their prospects, that's the primary fundamental fuel behind the rhythm we've been talking about.
Like if NVDA crushes earnings because of AI chips.
Exactly. That positive vibe, the capital flowing in, it ripples through the whole index much more strongly than if, say, a smaller tech firm beats its own targets. It's about that concentrated power at the top.
Okay. And then the report shifts to news, risks, events. And this is where it gets really interesting, sometimes a bit unsettling maybe. We know the Genius Bill apparently triggered that 4-week box pattern, but then it talks about geopolitical conflicts. It says they serve as justifications for liquidity control. And then get this, death and injuries seen as tokens in macro chessboard by institutional players.
Wow, that's a deeply cynical view.
It is, yeah. It's a provocative and frankly unsettling perspective from the source. And it's really important we just report this impartially, as their view, not ours.
Right, absolutely.
The analyst isn't saying these events aren't tragic on a human level. They're framing it purely from a strategic market viewpoint. The claim is that major institutional players might perceive and even use these global events, not just as disruptions, but as strategic tools to manage market liquidity.
Okay, liquidity control.
Yeah.
What does that actually mean here? How could a tragedy be used for that?
So liquidity control refers to the ability of these big players to either pull huge amounts of money out of the market, tightening liquidity, or inject it in loosening it, often in response to or even taking advantage of major geopolitical shifts.
So the idea is that market players might view these massive global events through a cold, calculated lens as chances to reshape capital flows. That's a very different way to look at the news.
It absolutely is. The thinking, according to this source, is that the uncertainty or panic these events create can be exploited.
Yeah.
For instance, a spike in tensions might cause a flight to safety, a sell-off in riskier assets. That creates an opportunity for institutions with deep pockets to buy assets cheaper, effectively controlling liquidity by stepping in when others flee. Or, flip side, a sudden de-escalation might cause a rush back into risk assets, letting them sell positions maybe.
And the tokens on a chessboard line.
Yeah, that language, death and injuries seen as tokens in macro chessboard is a really stark way of saying that from a purely detached strategic market perspective, human suffering might just be viewed as another variable, a trigger point in a cold calculation of capital movement rather than, an ethical issue. Again, this is not an endorsement of that view.
No, understood.
It's just reporting the source's claim about how some institutional players might perceive and use these events. It's provocative, maybe disturbing, but it encourages you, our listener, to think critically about the information you get. Not just about markets, but maybe about global news too.
Wow. Yeah, that definitely makes you think differently. Okay, shifting back to more traditional bullish drivers, the report points to two key things: AI optimism and the Federal Reserve's pause stance on rates. Why are these such powerful tailwinds, especially for the NASDAQ Q100?
Well, the combination of those two is incredibly significant, yeah. Especially for the NDX, given how tech-heavy it is. AI obviously represents this huge wave of innovation promising massive growth everywhere: software, cloud, chips, you name it.
Right, the AI hype is everywhere.
Exactly. And that potential attracts huge investment, fuels optimism. The companies leading the AI charge, many of them big NASDAQ names, are seen as the future leaders, so they command high valuations.
And the Fed pausing on rates, that's about borrowing costs, right? So no hikes means it's easier for companies to get money. Good for growth stocks.
Precisely. At the same time, the Fed holding off on rate hikes signals an environment where borrowing costs are stable, maybe even heading lower eventually. That makes it cheaper for companies to invest in R&D, expansion stuff tech companies do a lot. And it also makes growth stocks look more attractive to investors compared to, say, safer bonds, where the return isn't going up. So you have this combination: groundbreaking tech driving growth, AI, plus supportive monetary policy, easy money. That explains a big chunk of the market's upward momentum right now. It's like fertile soil for tech and growth stocks to thrive, even with those other global headwinds or cynical narratives floating around.
Okay, so understanding all these pieces, the technicals, the macro, the rhythms, the drivers, leads us to the practical side, strategies. The report lays out these distinct frameworks for different time horizons. These aren't like, do this advice, right? More like roadmaps.
That's exactly it. They're definitely not prescriptive advice telling you what to do. They're presented as detailed frameworks for strategic reference to help you understand how all these insights could translate into potential actions for different types of market participants, whether you're thinking short-term, medium-term swings, or long-term growth. The point is that a good market view should lead to flexible thinking, not just one rigid approach.
Okay, let's break down the three scenarios. First up, the short-term strategy. Who's this aimed at? What are the signs?
So the short-term strategy, the report gives an entry zone around 22,000. The conditions needed are that rhythm expansion we talked about, clear support at the short-term trend line, and ongoing momentum confirmation. This is really geared towards quick moves, capturing immediate upward momentum confirmed by those technical signals. Think day traders, very active investors looking for rapid responses, maybe holding for just hours or days. They're focused on that immediate melody of the market.
Okay, the quick melody, then there's the swing strategy. Sounds like a slightly longer view.
Correct. The swing strategy suggests an entry zone near 21,650. Conditions here are an expanded rhythm, solid trend confirmation, and something the report calls second stage trap clear.
Second stage trap clear. What's that mean?
It basically means the market seems to have moved past an initial tricky period, maybe a false start or breakdown that could have caught early investors out the trap. It confirms the trend looks more solid now, ready for a medium-term upward swing. This strategy aims for more sustained moves, maybe over a few days to a few weeks, trying to catch that larger chorus in the market's song after the initial noise has settled down.
Got it, the chorus. And finally, the midterm strategy. This sounds like the long game.
Indeed. The midterm strategy targets an entry zone around 21,500. The conditions here are a long-term rhythm breakout, a strong earnings tailwind from those big tech companies we mentioned, and what it calls structural wave support. This strategy is aiming for sustained, longer-term growth, supported by both powerful technical breakouts and strong fundamental earnings. It's about catching the broader, bigger market moves over months, aligning with the market's foundational baseline, its overall trajectory. For investors looking to ride a larger trend, less worried about the daily bumps.
It really shows that playing the market isn't one size fits all, does it? It really depends on your time frame, your tolerance for risk, and these strategies seem to cover that whole spectrum.
Absolutely. Each strategy illustrates how different people with different goals and risk appetites might approach things. It underlines that flexible thinking based on a comprehensive view is key. It allows you, the listener, to think about which framework might resonate most with your own investment style and horizon.
This whole idea of rhythm and now structural wave support, it leads us perfectly into the wave theory section. For anyone not familiar, can you give us the quick version of wave analysis or Elliott wave theory? Sounds complex, but it seems like a powerful tool in this report.
Sure. So, wave analysis, or Elliott wave theory as it's often known, basically suggests that market movements aren't random. They tend to happen in these predictable, repeating patterns. You get impulsive waves, usually 5 waves moving with the main trend, showing strong progress. And you get corrective waves, usually 3 waves moving against the trend, like pullbacks or pauses.
5 steps forward, 3 steps back, kind of.
Sort of, yeah. That's the classic pattern. 5 waves up in a bull trend, then 3 waves down, correcting it. And what's interesting here is the report specifically mentions wave 2 complete and wave 3 onset, likely.
And why is wave 3 so important in this theory? Is it just the next number?
No, wave 3 is typically the big one. It's usually the strongest and longest wave in that 5-wave sequence. It represents the period where the price moves most vigorously and the most people jump on board. So if wave 3 is indeed starting, as this report suggests, that signals potentially a period of significant, sustained growth ahead for the NASDAQ Q100. It's a very bullish signal in wave theory, the point where momentum really kicks in.
Okay, so the current phase, according to the source, is wave 2 complete, wave 3 onset, likely scenario accumulation between 21,500, approximately 22,000. What does accumulation mean there, and why that specific price range?
Right. So wave 2 complete means the market finished its correction, the pullback after the first move up, wave 1. Now it's building energy again. Accumulation means that smart money, often institutions, are likely steadily buying in the zone, building their positions, getting ready for that powerful wave 3 move up.
Buying during the lull.
Exactly. Buying while things are relatively quiet, anticipating the next big leg up. And that 21,500 to 22,000 range, that's identified as the zone where this buying, this accumulation is expected to happen. It's like the launch pad for wave 3, a consolidation before the next big push.
And the report actually gives specific wave targets. That really puts numbers on this, doesn't it? It makes it feel more concrete.
It absolutely does. The analysis lays out a clear potential path with actual price targets. It makes the whole abstract wave concept much more tangible, always remembering these are projections, of course.
Right. So what are the targets?
According to the source, the wave 1 peak was identified back at 23,000. That was the initial move up. The wave 2 base, the recent low after the correction, was around 21,500. That's the foundation, the launch pad we mentioned. And the projected wave 3 target is way up at 26,270. That represents the anticipated strong, sustained upward move.
Wow, 26,270. Okay, so for you, the listener, these targets give a really tangible sense of the potential upside here. It's not just it might go up, but a specific destination marker based on this framework.
Exactly. It provides a numerical context for the bullish case, helps build a picture of where the market might be heading based on these patterns rather than just reacting to today's price.
Okay, we've hit technicals, macro, rhythms, waves. But what about the crowd? What are people actually saying? The report looks at community sentiment from places like Reddit, Twitter. This is always fascinating. How does popular opinion line up, or not, with the expert analysis?
It really adds another dimension, yeah. Understanding the mood out there, especially among retail investors on these platforms, it can either confirm the technical view or provide a really interesting counterpoint. It's like taking the market's emotional temperature, which can definitely drive short-term moves or signal shifts in thinking.
So let's look at the specifics. First, Reddit, using hashtags #NDX, #stocks. What's the vibe there?
On Reddit, the sentiment is described as neutral-leaning bullish, but with a keynote. AI still hot, but overvaluation mention.
Ah, okay. So mostly positive, but some worries creeping in.
Exactly. Cautious optimism seems to be the feel. People are still excited about AI, see it as a driver, but there's this undercurrent of concern about prices maybe getting too high, too fast. Is it sustainable? A mix of excitement and maybe a little bit of anxiety.
Okay. How about stock twits? Using hashtag NDX100 and hashtag GeniusBill, are they more bullish?
StockTwits seems more straightforwardly excited. The report notes rising interest expecting strong move after Genius Bill. This sounds like direct anticipation of a breakout, linking it right back to that Genius Bill catalyst. It suggests a clear bullish expectation where, like, they think the box range is done and the move is coming, more focused on the immediate trigger, it seems.
And finally, Twitter. Using hashtag TechRally and hashtag MacroControl. That last one sounds like it might tie back to that cynical view we discussed.
It does, yeah. Twitter's sentiment is described as mixed, and notably it includes the idea that even war seen as a market control tool. This directly echoes that provocative macro control narrative from the analyst's report. It shows that perspective viewing global events through a strategic market manipulation lens is definitely circulating and being discussed out there on Twitter too. So
Interesting.
you have this segment of the Twitter market community viewing major events not just as random disruptions, but maybe as orchestrated parts of a bigger financial game played by powerful actors. This mixed sentiment with those skeptical undertones is a really interesting contrast to the simpler optimism seen elsewhere.
So for you, the listener, this really shows how diverse public opinion is. It's definitely not one single view across the board. Sometimes it aligns with the expert view. Sometimes it pushes back.
Precisely. It really highlights why you need to look at the whole landscape of opinion, not just one source, to get a feel for the market's psychology. It's a reminder that emotion and perception play a huge role alongside the numbers. But despite these different community views, the overall forecast from the analysts remains pretty clear. Box breakout likely, full swing wave beginning, so still confirming that bullish outlook overall.
But even with the bullish forecast, there are always risks, right? What potential problems does the report flag that could throw a wrench in the works?
Yeah, absolutely. The report wisely points out several key risks. First, earnings disappointments. Even if the overall trend for big tech is good, individual companies, even giants like Apple or Microsoft, could miss their specific earnings targets. A big miss from one of them could really sour the mood for the whole index. The market doesn't like negative surprises, especially from the leaders. Second, macro event fatigue. This one's interesting. The market might just get tired of reacting to big global events, especially ongoing geopolitical stuff. Either it becomes desensitized and future shocks have less impact, or maybe the prolonged uncertainty just wears investors down, leading to a sudden negative shift as people just get fed up and reduce risk.
Fatigue. Makes sense.
Yeah, and third, no fresh narratives. Markets love a good story, right? A reason to be optimistic. If the current big stories like AI optimism start to fade and nothing new and equally compelling comes along to drive excitement and attract new money, things could just stagnate. Investors are always looking for the next big thing.
Okay, those are clear risks. But then there's a positive flow factor mentioned. Continued AI fund inflow from institutions. That sounds like a pretty significant positive counterweight, right? Big money still coming in.
It absolutely is. That institutional money flowing into AI acts as a powerful tailwind.
Yeah.
It's a major validation of the bullish story when the big, sophisticated players, pension funds, hedge funds, are actively putting serious capital into the space. It provides real, sustained support. So for you, this gives a balanced picture. Yes, there are risks to watch, but there's also substantial institutional backing for this direction right now.
And speaking of institutional flow, the report really hammers this home in the advanced insight section. It says this flow is confirmed via leveraged ETFs, EGQQ.
Why is looking at leveraged ETFs so telling about what the big players are doing?
Well, this is seen as strong corroboration because leveraged ETFs like EGQQ, which tracks the NASDAQ Q100 with leverage, they're often used by bigger, more sophisticated players for directional bets. They want to amplify their exposure.
Not usually something small retail investors dive into heavily. Generally not, no. They're tools for institutions or very active traders who want magnified market views. So seeing increased activity there is taken as a strong, tangible signal of where big money is moving and their level of conviction. It's not just a theory. It's like seeing the actual footprints of large-scale investment heading in a bullish direction. Adds real weight to the forecast.
And it also mentions social media buzz and short interest. A plus 41% increase month over month in social mentions, and short interest being covered in low volume pops. Okay, break that down. What does that combo tell us?
Okay, the social buzz part, that 41% jump, shows growing public interest, excitement over the NASDAQ Q100. That can feed on itself, right? More talk, more awareness, potentially more retail buying, then short interest being covered. That means people who bet against the index, short sellers, are now giving up and buying back shares to close their positions, likely because they're losing money as the market goes up. This forced buying adds fuel to the rally, sometimes called a short squeeze.
Right, they have to buy.
Exactly. And low volume pops suggests these price increases are happening efficiently. The market's moving up without needing huge amounts of new buying volume, possibly because that short covering is helping push it. It can make the rally feel stronger, less likely to immediately reverse. So you've got growing public interest and shrinking pessimism fueling the move.
That does sound like a powerful mix. More people interested, and the doubters are retreating. But then there's this really crucial nuanced point about where the AI money is actually going. The report says AI flow heavily concentrated in mega-cap tech, mid-tier AI plateau. That suggests AI isn't lifting all the boats, right? What are the implications there?
Yeah, this is a really critical distinction. It gives a much more refined picture of the AI investment scene. While AI is driving a lot of excitement and money, the benefits are clearly not spread evenly. The vast majority of that institutional cash, the investor focus, it's pouring into the established giants, the NVDAs, Microsofts, Googles, Apples we keep mentioning.
Was with the resources already?
Exactly. They have the massive resources, the existing infrastructure, the customer bases, the market power to really deploy AI at scale. They can fund the huge R&D, integrate it into existing products people already use.
So the smaller, maybe more purely AI-focused companies, they might be struggling to get that same level of attention or investment, even with all the hype. Hitting a plateau. Sounds like a winner-take-most situation.
That's precisely the implication. Yeah, winner-take-most is a good way to put it. It means that while the overall AI story is bullish, you need to be really discerning about where the money is actually landing. Smaller or mid-tier AI firms, even if they have cool tech, might just lack the scale, the funding, the market reach to attract the same flood of institutional capital right now. They hit a plateau because the big money is prioritizing the established players, seen as safer, more scalable bets. So for you, the listener, it's a nuanced understanding. General AI optimism doesn't mean every AI stock is a guaranteed winner. Far from it. It highlights that concentration, and it really matters for diversification, for assessing risk in smaller companies, and for understanding where the core growth is currently expected.
Okay, wow. We have covered so much ground here. Layer after layer of this market. Let's try and bring it all together now. Summarize the actual predictions from this deep analysis, pulling in the technicals, rhythms, waves, macro stuff. What's the bottom line? The investment outlook for the NASDAQ Q100 on the road ahead, according to this source.
Right. Synthesizing everything, the analysis presents a pretty optimistic picture with very specific targets based on that blend of technicals, rhythm, and wave theory we're looking at. A short-term rhythm breakout is seen as likely, with an immediate target of 23,000. That's for the near-term view. Then, a swing solid uptrend is anticipated, targeting 24,900. That suggests a pretty robust medium-term move building from here. And looking further out, a mid-term long-range continuation is expected to potentially reach 26,270. That's the most ambitious target, obviously, suggesting a sustained upward path over a longer period.
And you mentioned earlier about probability and yield being higher, closer to those key trend lines. Does that idea support the confidence in these longer-term targets too?
It absolutely does. Yeah, that principle connects back to our discussion on those key technical zones. The fact that the market is showing these strong rhythm expansions and apparent wave formations while near these important established support levels, that increases the calculated probability that these upward targets could be met. And crucially, it suggests the potential returns, the yield. For those aligned with the trend might be higher because the market appears to be moving with strong conviction from a solid base. So for you, the listener, these targets offer this clear potential roadmap for the NASDAQ Q100. Tangible numbers to think about, grounded in all the analysis we've just walked through. It helps build that multi-layered picture of where the market might head, not just reacting to today, but understanding the forces driving its potential future.
And there you have it. What an incredible deep dive into the NASDAQ Q100. We've seen how this really key index is potentially breaking out of that recent box range, driven by this underlying rhythm expansion, backed by strong tech fundamentals, especially those huge companies like NVDA and Microsoft. We looked at the big tailwinds, AI optimism, the Fed's stance, seemingly confirmed by significant institutional money flowing in. And we navigated all that alongside some really fascinating, sometimes unsettling macro ideas and clearly identified risks like earnings misses or just plain fatigue. Hopefully, you now have a much more layered understanding of these complex market dynamics, moving way beyond just the headlines to a more informed, more nuanced perspective.
Indeed. We've really explored how technical analysis, this rhythm concept, wave theory, they can provide a framework.
Yeah.
And how even things like community sentiment and institutional flows add pieces to the puzzle. It's about trying to see the market as this dynamic system, maybe with underlying patterns, not just random noise.
So, as you go about your day, thinking about the news, making decisions, maybe consider this. If market patterns really can follow these rhythms and waves, and if, like our source suggested, even huge global events might be viewed by some powerful players as just tools for liquidity control, how might understanding those hidden narratives, those potential underlying patterns, fundamentally change how you approach information? It's a provocative thought. Maybe it pushes you to always look a bit deeper, question the surface level, not just in markets, but maybe in life itself. Thanks for diving deep with us.